evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly video for April 30th, 2019. And I know we have Apple earnings, we had Google earnings, but we'll pull the perspective up from that to look at the sectors, which is mainly money flow. Yeah, big tech names are reporting. Some of them hit, some of them miss. Google was a surprise. We'll know Apple by Wednesday morning. I don't know it right now in terms of when the video is produced, so you'll be able to look at Apple's reports and earnings, and we'll play them into Wednesday, Thursday, and Friday if need be. But we'll take a look at the S&P at all-time highs, NASDAQ also at all-time highs, and just ask a question. What does money flow say about this? And what clues can we get from the sectors? Hint, not all bullish. Well, let's start with the top three. These are the sector spiders for the financials, XLF, technology, XLK, and my goodness, look at that steady uptrend. XLY is consumer discretionary. These, we'll focus on those just for a minute, are considered offensive or risk-on sectors. If the economy is getting strong and stronger and the stock market's going higher and higher, you typically see money flow into these three top sectors. And that's ultimately what we're seeing. The one exception to that is the financial sector, which is XLF. It did break a resistance high at 27 and is now trading at 28 per share. That is not a new lifetime high. Unlike technology, and keep this in mind that technology did make a new high, or at least the XLK, which is more of a focused technology fund, did make new highs well in advance of the NASDAQ. So that was to an extent a leading indicator of money flow and how that suggested higher highs in the equity markets. The same is taking place here in XLY, which is broad-based consumer discretionary. We think of these as retail or entertainment or different things that when the economy is doing well, people will spend money on. Vacations, hotels, leisure, etc. It's actually a broad category for how consumers are spending. The middle sectors are industrials, materials, and energy. Something odd is happening because none of these are at all-time highs. These are mid-sector or mid-cycle sectors. It's what you would expect if the market makes new highs. These should be joining, but they're not. So we'll keep a watch on these from industrials, materials, and I think something really interesting is going on here for energy. And in fact, if you look closely, energy, or XLE, is the weakest of all of our 9 sectors. That's to do with crude oil. Now, crude is doing well, not as well as the equity market perhaps, but XLE energy, which includes Chevron and ExxonMobil and different stocks like that, you're seeing a pullback from the highs. So that's something to watch closely for other opportunities. Now, here's where it gets interesting. The 3 sectors at the bottom are our defensive names. XLP is staples. That typically goes hand in hand with consumer discretionary. So XLY and XLP do have a relationship. Typically, it is the offensive or risk on and defensive or risk off. Think about it. In a recession or a down market, you still have to brush your teeth. You still have to eat and you still have to drink. So you don't have to go on vacations. That's why we look at the XLY as a more risk on sector and the XLP as a risk off. Colgate, Palmolive, Johnson & Johnson, Kellogg's, Campbell's Soup Company, all those things would fall under consumer staples. Now we have healthcare, which is XLV. Despite being in the headlines, it's not doing well. It's not strengthening and getting higher or stronger. It's kind of right there with XLE, which is at the midpoint of its recovery phase. Where the S&P is all the way back to highs, so is technology, discretionary, and staples, but not XLV for healthcare. So that's something to watch as well for relative weakness. And the one I think we have our most attention on right now is utilities, XOU, and that is just shy of its new all-time highs. So that's a quick overview of our 9 sectors. Let's jump now to the daily charts. But before we talk about those sectors we want to focus on, let's just go ahead and take a look at the broader S&P 500. Now, again, This is a market that just nipped a little bit to new all-time highs, and the question for another day is, will this creep rally keep going and take us toward 3,000, or will this be at least a short-term top in the market? We don't know that, but everything we do is in that context. If the market keeps trading above 2950, probably additional sectors, additional stocks, and of course, the market itself and market-related ETFs, well, they'll keep trading bullishly as well. And that would open a pathway to 3,000 in the S&P. If we also look at the NASDAQ is just into the 7,800 level, and again is well above its October high from 2018. And that's been a persistent uptrend as well. Financials, we won't go through all the names, but just a quick check, because financials are important to the health of the broader market. Well, those are saying, I'm beneath the highs, or at least I'm not at all-time highs. Again, Goldman Sachs, MasterCard, all the things we think about financial stocks, those will be part of the XLF. Other strong sectors would include technology, which that's NASDAQ-centric, and that is a persistent, really wouldn't say unprecedented, but stellar 2019 rally. And that is just shy of the 80 per share level in the ETF. We like to buy trades on pullbacks or put positions on pullbacks or retracements, ideally to rising moving averages. That is a 20-day exponential, and a couple of positions have presented themselves as they do at the moment. Of course, if the market ever starts to fall under these levels, that could be a catalyst, as we saw over here, for extended sell-off. So we are watching that closely for this bounce or collapse. So far, we've had nothing but bounce in 2018. And that's the same for the market as well. We'll look at two more. XLY is your consumer discretionary. Just like the technology sector, it's crept its way to new highs above 120 per share. That is again above the 2018 high. It's on a pullback, or at least retracing toward the 20 moving average, which is going to be our focal point for this week and the next. One last one is the utilities, XLU, and that does function as a bond fund, or at least a defensive or risk-off name. If you're seeing money flow rapidly into utilities, or see fund behavior, volume, and etc. pick up in the utility sector or utility names, that's not necessarily good for the broader equity market. That's a sign of caution or defensiveness. And we can see this in bonds, again, for a future video. But right now, with the market at all-time highs, you would think the XLU utilities might be ticking to the downside. Well, that's not the case. They're getting volume flow to the upside, a little bit stronger volume, and of course, this most recent bounce off the 57 level, which is its 50-day exponential average. Let's keep a watch on this as we look at TLT, bonds, and other factors that might indicate risk off or a shift in money flow to the bearish side of the market. Barring that, well, this market keeps going up, and we like it, love it, hate it. If we're still above S&P 2950, well, the pathway opens up. And if that happens, we'll probably see bonds push beneath these support levels. So continue watching XLU Utilities, XLK Technology, XLF Financials, and any other sector and stocks in which you're investing. We get clues from these from money flow. And that's what the big traders are thinking and where they're putting their money. So we need to follow them as best we can. As always, be safe and careful. This is Corey Rosenblum with your Theo Nightly video for April 30th, 2019.